Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, August 9th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at just the markets in general this week. And we're going to look at how the index is doing, what's our general opinion, what's jumping out to us right now in the market, just kind of general commentary. Then we're going to take a look back at some price action and see if any sort of price action chart reading can give us any indication on the indicators. So we'll refresh some of the chart reading techniques that we follow. They're kind of always under construction and we're always learning from them. So it's probably going to be a little bit different than the last time we visited price action charting. And then lastly, I'm going to pull up two potential plays that I'm looking at. Not sure if I'm going to execute them on or not, but it's something I was out there looking for. That is with Palo Alto and ORCL. But before we hop to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello to Viper, myself, some of the other Blockhead traders. We love to hear what type of content you want to hear about and what type of content you're interested in. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick up an audio version of this wherever you get your podcasts. And if you look for it there and you can't find it, let us know and we will get it there. But let's hop to this week's content. And Viper, the market has really been kind of going up and to the right now for a while. And I personally find that really boring because it doesn't really fit my trading style and the type of things that I like to engage in. I like a lot of volatility. I like to sell that premium. And honestly, when you get a continuous grind that is up and to that right, the volatility just kind of declines. The VIX really at like all-time lows of recent memory. And maybe I was just spoiled in the throes of COVID and all the volatility that came with that. But it's really hard to find risk-reward plays that, I'm really interested in. And so I've been getting in different plays and I've really been waiting for a decent market pullback. And we might be on the precipice of one of these, decent retracements finally. We had a little bit of we almost made it back up to all-time highs, I think, in the S&P. Well, not all-time. Yeah, it was all-time highs, which was, I don't know, what was that, December of 22, something like that was the last time we reached there. A couple weeks ago, we got real close and we kind of pulled back a little bit. And then this past week, there was some downgrades in the banks. There was some indication of economic softening within China. We got past another rate hike, and I don't know, maybe the market is really looking for excuses not to go higher. I'm not sure. It feels really different to me, but I'm kind of getting a little bit optimistic here that we might get a decent retracement and bring a little bit of volatility and climbing back on the VIX to make premium selling more interesting. You've been keeping an eye on much, Viper?
Not super closely, but definitely, I guess the analogy would be I hear the conversations, like I'm in the, I'm eavesdropping in the room, like I'm having my own conversation, but there's a lot of people talking around me. And so I catch a sense that way. But I've still, I've talked many times on the show about my two index ETF plays. So I do pay attention, to the indices, for those two particular plays. And a real quick note on those is because that same I don't want to call it a top, but that same moment you just referred to where we just kept going up and up and up to the right. We didn't quite make new all-time highs, but then we started to pull back from there. So I took that as an indication because, that those two index ETFs that I had were, meant to be, like I said, opportunistic for recovery of how far we've dropped into the recession, into the rate hikes and all that kind of stuff. So I followed through on that thesis, and we were so close to the top. I was like, hold on, why am I still like, I have a chance here. Like they were very nicely in profit because of the just constant buying as we came down and then buying as we came up. So I actually closed both of those because of everything you just said, and because the thesis of that trade was not to do this forever. It was, let's capture this moment of recovery, and then we'll see what happens. And so, I mean, if we do get this big pullback that you're looking for, maybe I start it up again. But I did think that was an interesting note that kind of plays into this. So I guess I'll just leave it at that. That's my read. Is I feel kind of the same thing you're feeling, and the long play I had on the indexes was satisfied, at least satisfied enough that I went ahead and shut those down, rang the register.
Man, I didn't know you did that. Now you got me all freaked out about lightning striking twice. Do you remember what happened last December? I started like getting a little bit long or carrying a lot of shares of things to pick up dividends and things. And you're like, yeah, coincidentally, I just kind of sold everything I had and I'm out of the market. And then whammo, there we go, down 30%. And the whole way I'm going, oh, and you're like, actually, I'm just waiting here with cash on the sidelines. Man.
You just said you wanted a pullback, right?
Well, I do now. I'm positioned for one. Back then, when you did this the last time and exited the market, I wasn't ready.
I mean, I didn't fully exit. I just exited those indices. But I mean, if it makes you feel any better, it was, real life. There was a lot of profit there, and got some big bills, some big things happening. So it was just a nice little time to shave a little off the top, if that makes you feel any better.
Yeah. All right. Well, the other area of the market that I'm kind of keeping my eye on, and mostly I'm just keeping my eye on it because it just seems too good to be true, and that's AI. I'm not a big, I don't know. AI is everywhere. I think anytime anybody is like, does anybody have any good ideas? Somebody jumps up and says, how about we use AI or something like that. And it's just everywhere to the point of just nonsense to me. But that has translated into nonsense in a lot of stocks that have strong ties to AI. I mean, NVIDIA a while back, I think we even mentioned it on this show, popped after a surprise beat on earnings after they already adjusted up their estimates 1 month earlier, and then they whammoed through that estimation, and the stock jumped 30% in the following trading day. And then every company and their brother and cousin related to AI has just been going to the moon in a parabolic form. Ironically, I was caught up in that with one of my trades on Super Micro, just getting pummeled because I was short on a call. I bring this up because I'm looking for volatility, and I'm finding volatility surfacing in the tech area, particularly also in those names connected with AI. And not from a standpoint of where I want to sell puts to be bullish, but from the standpoint of, holy smokes, this is the most stretched, crazy piling in of earnings multiples that I've seen. And just recently, some of that AI trade is starting to show some cracks with companies kind of downgrading some of their forecasts looking forward as far as, hey, we thought this was going to be gangbusters, but it's maybe not, it's going to be big, but maybe not as big as we might have led on to believe. And that's just causing a lot of these names to really collapse pretty hard. And so if you're in the world of shorts, I think there is a lot of opportunities there. And then whenever stocks get to all-time highs like that, that drives volatility because you're extending past their normal range. And then when you get this rubber band drop, there is some premium in that area. So Viper, I am kind of keeping my eyes in there to see if any trades might manifest themselves here in the coming days. So one thing that we have done in the past is kind of use price action in charting to make some probabilistic guesses about where certain things might be headed. Like I said, it's a lot more of a probability that things could do something rather than it's doing this, therefore this is the next logical outcome. I know it will always sound like that when you hear people reading charts and stuff like that. They're like, well, it hit this level here and we're going to bounce from here and go back up to this level. And it's never quite as definitive as that. It's, there is this level here, and so there is a high probability if we hit this level and test off of this level that we're going to go somewhere else, and it's not with certainty, but probability. And so, Viper, I don't know if you have gotten a chance to take a look at maybe some indices, maybe refresh some of our chart reading price action here, but what are they telling us?
Yeah, and I mean, I think that's really important to, one of those things, first of all, like you said at the top of the show, that as we get into some price action stuff, like it's very much an evolving skill set that I think both of us are evolving in similar and slightly different ways. And it's also the thing that, just like you said, it's not like it's easy to, say that, there's a bunch of people out there that, will read charts with this definitive, like, this is what's happening, this is coming next, and yada, yada. Obviously that they're sensational and whatnot, but I want to call out is the very real tendency for all of us to do that, And they just happen to do it on a much more elevated and theatrical level. Like, I mean, I constantly find myself reading a chart with the best of intentions, and as soon as I see, a particular mechanic in the chart, I start telling myself XYZ is what's going to happen. And you start to lose the beat on, no, it's not going, it's just most likely. So really want to keep bringing attention to that every time we talk about chart reading, that even if you think you're not, like I very much would like to think that we're not that kind of show of like, this is what's going to happen. And like, even though we're not that guy, like it still is just this thing of like, you want to be right. You want to have confidence. And there's a very fine line between having chart confidence in what's most likely about to happen and letting yourself think that's what's going to happen. So, with that said, though, let's look at the SPY here, because it's on brand here, talking about my ETFs closing and whatnot. And what I wanted to do was just clear the chart completely naked. Like, let's take a look at this now through the lens of just some of the maturation of my chart reading skills. Far from over, still a long, long way to go. But compared to the last time we did any price action, I feel like it's gotten a little sharper. So I wanted to kind of dig into that. So some of this is a chart reading, but some of it is also thinking out loud of processing a naked chart and how to make sense of it. So right off the bat here, we're looking at the 1 hour chart. And so obviously the first thing a lot of people, when they look at this chart, is gonna be like, I don't know, what's it mean? Like, we were kind of rounded here, and like you start to zoom out. And it's very natural to all of a sudden, like, this is really noisy. Like, what's important here? I don't know. There's, all these little waves up and down, and you can get lost really quickly, being this far in. So, what I like to do coming into a chart clean, is let's just back it up. Let's say, okay, let's back up to the 4 hours and let's look at that. Is that any cleaner? I mean, it's cleaner, but it's still, honestly, like, even to me today, it's still a little hard to get, like, I can start to get an idea of what's important and what's not, but it's still a little hard because it's still a little noisy. So we say, all right, let's just keep backing it up. I'll save you the time and say, okay, I go all the way back to the 1 month. And this is where it's almost too, it's almost too, I don't know the word, but not granular. But there are some interesting things here that I had charted this out ahead of time, and the furthest back I went was the weekly. And then I did that. I got, I kind of processed so I could talk about it here. And then I was like, what does the monthly look like? And I was like, oh, wow, the monthly actually kind of shows things pretty well here. So what I mean by that is now, first of all, I think we can all agree this is a lot cleaner in that there's just not the noise that we saw when we were zoomed in lower. But it is very important to remember these candles each represent one entire month. But nonetheless, we can still see the price action that we're interested in. Specifically, what we can see is we see our big rise here all through 2020 and then into 2021. And then we see our all-time high up here, and then we see that we're starting to come back. So the thing that we always want to pay attention to on charts, no matter what the time frame is we want to know what's happening on the current swings and where was the most recent failure points. And then what's the current range that we care about based on those failure points. And the one thing that I'm still trying to get my brain bent to is that concept of chart the failures. Where did it fail to do something? Where did it fail to, whatever? And so in this particular case, we did have this big long run up. We made a little low here. It was just a local low. It was far from a new low. So this is looking at September 2021. So we pulled back, we made a local low here, then we marched on up and we got our all-time high that we pulled back from. So we pulled back and you got these 2 months of red candles. This second month red candle here, it's important to note that and we're talking candle closes for all of this, at least right now. So this second red month here pullback, we closed above this local low we made on our way up. So this is not a failure of any kind. This was just a pullback. The next month we marched up on a green candle. So that was fine. There was no failure there. Now we get to this red candle, which was April 2022, and we see that this candle closed below that local low that we talked about on the march up. So now this candle represents a failure because we failed to hold that low. So here we'll mark the start of the move that made that low, which is the top of the candle, because that candle failed to hold. It could have fallen down and held here, and then it's no longer the start of a failing move. It was just a move. But since this candle dropped all the way down here, we're going to mark that as the start of the failure move. And then it continued to go down and this is only because we're on the monthly, and this represents such a huge point in time. I'm going to go ahead and mark this candle here because this was now another failure. I mean, it's a continuation of that failure. But again, because these candles represent so much time, I want to go ahead and mark that candle because that made a new low. And then lastly, let's do this one here because we got this green candle and it didn't quite break through. And then these two red candles, August and September of 2022, this August candle is the start of the move that ended up putting in this new low down here. So these give us a pretty good idea of what we're dealing with here on a very big picture. And we can kind of see that we have two ranges that we care about in this. We have this range here, which is just the range between these two failures. And then we kind of have a much, much bigger range, which is the range between these two failures up here. So for just a second, well, I'll leave the colored, now I'll take the second colored box out. So there's some interesting things around this first range here, but now we're hitting the point where we need more information. These candles don't give us enough detail. The one thing they do tell us, though, is at least on these monthly candles, we can see that we kind of plowed through this range and we went all the way up and we gained ever so slightly this top level here. So we gained it and then now we've lost it. I mean, there's 21 days left in this candle, but currently, until this candle closes, currently it's losing, but we got to be careful, closing candles only. But nonetheless, What this says to me is we didn't do a whole lot of testing, at least on this time frame. We didn't do a whole lot of testing of this big range down here that failed. So in the grand scheme of things, as far as closing those positions I had and Sprocket talking about that pullback, a pullback makes a ton of sense from the price action here. I mean, we came all the way up, at least on the monthly candles. I'll do it a little faster, but we'll go through some of the lower time frames. There is a very natural expectation of probability that at some point you're going to pull back, and it would be perfectly natural to test this 415, the high of the range. We gained this range sufficiently, this bottom range here. We gained it. We have closing candles above it. But we don't have any tests from the top side. So there's a fully acceptable expectation that on these monthly candles, we could come down and test the top of that range. But that's on this time frame. And so that's an important thing that I also struggle with, is keeping perspective of what plays are on what time frames. So in the case of my ETFs, those were on a long time frame trade. I was pecking away at those things over months and months and months. So a monthly candle time frame kind of makes sense that, we got this big move up. I went ahead and cashed out, and there's an expectation on a monthly candle basis, which easily could take 6 to 7 to 8 months to play out. But there is an expectation to come down and test the top of this failure range down here at 415. But the main thing here was just identifying the key ranges on this monthly level. If we drill down now to the daily chart, and we can kind of see, leaving those levels that we just grabbed off the monthly, we can kind of see how things have been tested on the daily in relation to those. And we can see this range down here, this big range that I mentioned we broke through and gained. It's very well tested inside this range on the daily candle chart. You can see that we have, we came up in, we got a clear test of the top side, we came down, it pinged around in here and did it really fully tested before it broke out. So that adds to the thesis that if we're going to eventually get ourselves to all-time highs, we definitely, most ultimately, do not want to lose this 415 level, because we are well tested and well clear of the range below that. So there is an expectation, like I said, on that monthly candle, that we could come down, test the high side of this range. Now what I want to watch, if we ever get down there, is do not lose that range. We don't want to lose it on the chart we charted it. So all the way back up at the monthly, we don't want a monthly closing candle below that range. But that, again, that's a really high time frame. So I won't do it now to save us some time, but basically you just take that same logic that I just applied on the monthly candle and you can apply it on the daily. These ranges, or these levels, were drawn from the monthly, and we're looking at a daily chart. So that means they're not golden per se. They're important, but there's a lot of action you can see here on the daily with granularity that lends itself to different ranges or different levels that are important to the daily candle. So without doing a full read on it, I would say we have a failure. Well, we had a failure. This was the start back here. This was the start of a failed move to come back up and regain here that came down. You can see we rejected off of it. This is ways that you can add some details as you zoom in a little bit. That as far as a daily closing candle goes, I kind of don't really want to see a daily close below 428 if my time horizon for whatever play I'm looking at, if that's more applicable to it. So on this daily chart, now I'd say maybe there's an expectation of, certainly holding 428. But there's probably some additional, so the start of the move that made the local high here kind of came from 432 here. So I would, this is a pretty open range right here. This is a pretty open range right here, which we don't really have any tests on. To wrap it up, I would say on a shorter time frame, this 428 to 432 looks like a really healthy area to pull back to and to get some tests in here. There are currently no tests of this range, so we could come back, we could test the top of it, we could test the bottom of it, and that's all perfectly fine for an upwards thesis. But beyond that, we got to see what it does, how it reacts around there before we start to wonder if there's reversals in play. But I'm gonna leave this here on this chart. I don't use this chart a lot, so let's leave this here and see what happens on this potential pullback. Well, there's a pullback in progress, but I like this range 428, 432. I don't know if you've done any reading on this index, if that jives with you at all, or if you haven't really given it much thought.
No, I'll say I haven't really given it much thought. It's one of the things that I want to try to do more frequently is keep charts on the indexes, because I think it helps me not so much know where the market is going, I guess, but more when to be more patient and wait on the sidelines for that volatility to build. And so like right now, I have a little bit of buying power looking to deploy. And what I'm trying to get my brain around is say, hey, calm down, be patient. We appear to be in a retrace here. So let this play out. Let this thing kind of pull back. Let the volatility creep in, and you're going to have better opportunities to sell premium if you just hold out a little bit. And I think that's where I need to be a little bit more disciplined to kind of keep my eye on this. I keep tabs on indexes from the standpoint that I almost a lot lately, I have open short positions on the indexes. Not because I think the market is going to go down. I have those on for my trading style of selling premium, where I want to remain delta neutral. And I know we've talked about this in the past, and I won't spend a ton of time on it in this episode for the sake of time. But delta is your directional risk. And when you're selling premium, you do not want directional risk. You basically just want to burn your theta off. And so the way that you can counteract, because a lot of times I sell puts because I find them safer. I'm more comfortable with them because a lot of times I'm okay holding the shares if I get assigned. And when you sell puts, you tend to give yourself positive delta risk. And in order to counterbalance that, I have to pick up negative delta. And that basically means I need things to go down. And the most easiest way to pick up general purpose negative delta is to short an index. You can get negative delta by shorting particular equities, particular ETFs, things like that. But it's kind of like, it's not as general and multi-purpose. Think of it like a multi-purpose cleaner, right? You can get degreaser, which is really good at getting grease out of something, but maybe it doesn't do so good at getting rid of bacteria, right? It's not antibacterial, but you can get a general purpose cleaner to do your degreasing, your antibacterial, stuff like that, and that counteracts better. And so I do keep an eye on indexes from the standpoint that lately I seem to always have some level of shorts on the index to counterbalance my positive delta from my premium selling.
That makes sense. And I think the last thing I'll say on this chart, because I don't like just leaving a bare line up here for the top side, I think it's important, even if you're wrong, even if you're way off the mark, and I'm certainly not claiming that I'm on the mark here. Some of this was just on the fly. I didn't even prepare when I looked at the chart before, but I think it's really important to always have a range in mind. Have an important range and why it's important. So the last thing I want to throw down is I think this anchoring way back here to create a range up here is important, and this is kind of will ultimately speak to those shorts and being patient for the pullback, because if we create this range, which was anchored on, again, a big failure that took us to lows, so something we didn't really want to lose, but you can kind of see here that we did lose, and we got our closing below, and we had a test from the bottom side. So this range here, you can see we came up through it, we gained it, we came back down, we closed below it, and then we came back up into it, and we didn't do anything meaningful. We lost it again. We came back up, and we rejected off the bottom of it. So now, again, speaking to those probabilities, probability is a lower low, and a lower low that is lower than the most recent low, which is right back here. So the probability is that we are on a retrace, we are on a pullback to get back down here to tests and put in a low lower than this, which again, testing the bottom of this range would fully satisfy that. So to me right now, that's where my probability seems to stand, is that we're on a direction back down to here, but this is where you got to really stop from getting in your own head. And that's not what's definitely going to happen. And at any point in time, it could show signs of pulling out of that. And so that's why you kind of, it's a very, I don't know, fluid thing. And I get why people don't like it. I get why people think it's all foo-foo and hocus pocus. But I don't know. It is what it is. That's what I'm seeing. And let's leave that up there and see what happens.
No doubt. We'll see what happens. Kind of speaking of trying to be patient, I got that buying power sitting around looking to deploy some of it. And so I started doing a little bit of screening, kind of going to almost that AI play that I was talking about earlier, tech play. And, let me just show you a couple of charts here that I'm looking at from a potential play. So I'm going to run through these really quick. There are things that popped up in my screener this evening when I started trying to look to see what might be a potential play. And I'll just take a look at I'll just show you what I was looking at. The first thing we're going to look at here is ORCL. So the IV percentile of ORCL is above 60% right now. It's about 61% IV rank, and it currently trades around the $100-ish mark. And so that is a pretty good combo, in my opinion, for what I'm looking for from we got an extended volatility. It's a higher price underlying, so usually the premiums are going to be pretty decent. And so I like to play a lot of plays as neutral as possible. So when I can throw out strangles, I've been getting more comfortable with the strangles. I only like the strangles once we kind of pushed up into some high and are kind of backing away from it, because a strangle does involve a naked call, and those can really put some pressure on you if those get breached. And so conservative side of this for me would just drop the call side. However, because the two plays I'm going to call out are really aggressively climbing, there's a lot of call skew in the option chain, which basically means the calls have a disproportionately higher premium than the puts. So it's a little more lucrative to sell those calls. Now, the reason for that is they are a higher risk. And so when risk is higher, you have to be compensated for that risk. And so what I'm looking at here is a 125 call and a 100 put expiring in September 15th. That is about a month out from where we are now. And you can see this is two contracts, potentially bringing in about $480, risking about $2,800 of buying power, pulling in about $17 in theta. Theta is the thing I like to collect. That is the premium that will just decay away. And the delta risk on this is about a negative 14 delta, so pretty delta neutral. So this shows you, this P&L here is kind of showing you this range that my break-evens are up here at like 127 and down below about $97. So very, very nice. If you want to flip it around and look at it in a different dynamic, I can pull up this chart here. So you can see it's kind of going down. I just needed to stay in that channel long enough for the premium to decay away. I'll close it out. I'll make my money. The one cautionary thing about this, you can see there's an E, a purple E down there in the corner. That basically means an earnings announcement. And so if I played this, I want to definitely be out before that earnings announcement. There's a little bit of risk that volatility could climb heading to that earnings, because that typically is something that causes volatility to rise. Volatility has been rising. So that is a cautionary area that I'd want to be a little bit careful of, knowing that earnings are coming out there towards the end of that holding period. So the next one that I wanted to take a look at real quick is Palo Alto. It's another tech company, tech thing. They make firewalls and things like that for the IT industry. Again, this Palo Alto is at 64% IV rank. So again, we're looking here for that elevated volatility historically. So it's in that above 50% prime for volatility contraction. And again, the chart of this thing is kind of pushed up to, 52-week highs recently. We had a massive drop down, and it's starting to bottom out of there. And so that's the type of area where I'm not as scared of taking the naked call side. But again, just like the other one, to reduce risk, I could drop the naked call, just go with the naked put. And you can see here that I'm going to be short the 250 call and short the 195 put. That's going to bring in $6.75 or $675 for one contract, risking about $3,200, $3,300 in buying power premium. And if we go ahead and flip over to the same different like dimensional look that we showed for the Oracle, you can see where this is in that channel. The difference here, again, is calling out where you see there is a purple E. That purple E is a lot closer to the start of this trade. And that's where I'm pretty comfortable with entering this. Because if you look there, we've already come considerably far down from that top side. Earnings announcements are binary events, which, Viper and I are notorious for saying really just accelerate the price action that's already there. And so if I look at this chart, and I haven't done any levels or anything, but just visually look at it, look back there to the left, and you can kind of see that we're tracing back to where that previous big swing started from. And so if earnings come out, there's two areas that I believe are probabilistic to arrive at, right? So if we're going to accelerate that price action, we're going to accelerate the speed down to that level for testing, or we're going to accelerate it back up to the upper end of that range for testing. And in this particular play, you'll see I have pretty good room on the ceiling to get back to those previous levels on the high side. And I don't have a ton of room to get to those levels on the bottom side, but with any play that I play with a strangle like this, I'm okay holding shares. And so this one, I'm pretty comfortable that earnings are coming up close because there should be a volatility contraction after that. And I feel like this particular positioning of that underlying price is pretty decently in a range that I'm comfortable with as far as the levels that I didn't chart, but just looking at that thing visually can imagine where they are. So that brings us to the end of this week's episode. The indexes have really been on a tear. They're starting to take a little bit of a breather. The price action that we kind of reviewed here really kind of suggests that we could be in for a little bit of a retracement. Not calling out a reversal or anything like that, but hey, we've really been stretching up and to the right here for a good bit of time. We have a failure to make a new high, and it looks really like we are on a trend for a retracement to where the swing might have started from or somewhere thereabouts. So, we'll see how that goes. That will be well for me, who is a premium selling kind of guy, and I need a little bit more volatility in the market. So right now, the only areas that are providing some of that volatility are those tech trades / AI trades. Two of the tech trades that I think are looking pretty decent from a premium selling for me are Oracle and Palo Alto. Really don't know anything about either of those companies, but both of the premiums on those options are in the above 60% historical volatility. That's really start to be in that key area where I like to sell for that volatility contraction. Remember, I don't need to get any sort of direction on price right. All I really need for premium selling is the volatility to collapse and time to pass. One of those two things, if they both happen at the same time, I arrive at profitability even faster. Hopefully you yourself are finding interesting things to trade. We'd love to hear about them in our Discord. Hop in, let us know. Otherwise, good luck out there. And remember, think outside the block.